Look at your chart right now. The Australian dollar is down for the third straight session, and everyone in your trading group is screaming sell. But here's the statistic that should make your heart beat a little faster. The CCI on the daily chart has pushed below -138, a level that, over the last 3 years, has preceded a mean reversion rally of at least 40 to 60 pips within 3 sessions, on 8 of the last 10 occurrences. There is one danger zone and one hidden opportunity right now, and I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, with stops and targets down to the pip. The session bias is a fading countertrend. This market is in a daily strong sell, a 5-hour strong sell, but the 1-hour chart has flipped neutral, and momentum is compressing. That compression at a major monthly support zone creates an environment where fresh shorts get trapped and fuel a sharp reactive rally. The single invalidation level that flips the entire bias is 0.6967. Write this number down. If we get a 4-hour close below 0.6967, the downtrend resumes with full conviction and the daily strong sell accelerates towards 0.6929 and then 0.6886, which is the 200-day moving average. Until that level breaks, we are in a bearish structure that is bleeding out, but we are at the very edge of a support floor that institutions are watching more closely than anything else on the G10 board. Now let's pull the chart apart from top to bottom. Start on the weekly time frame. The weekly trend is officially neutral, not bearish. That immediately tells you the higher time frame players are not yet in a full distribution cycle. Price is trading below the 5-week and 10-week moving averages, but it is still holding above the 20-week average at 0.7034, the pivot point, and the 200-week average is way down at 0.6886, which is a magnet but also a massive structural support. What's critical is that the weekly MACD histogram is ticking lower, but it has not crossed into negative territory. That means the weekly momentum is waning, but it has not confirmed a bearish reversal. So when you hear people say Aussie is in freefall, they are trading on emotion, not data. Drill down to the daily chart. The daily is a strong sell, and the moving averages confirm it. Price is below the 5-day at 0.7050, below the 10-day at 0.7077, below the 20-day at 0.7113, and below the 50-day at 0.7121. That is a textbook bearish alignment. MACD is negative at -0.003, and the signal line has crossed below zero. RSI is at 35.8, which is weak but not yet oversold, and stochastic is at 27, trending lower. But here's what most traders miss. Look at the ADX reading, 39.8. That's high, very high. An ADX above 40 on a daily chart means the trend is strong, but it also means exhaustion is close. When you combine an extreme ADX with a CCI below -130, you are entering a zone where the trend is overextended and the probability of a snapback violently increases. This is the hidden divergence that no retail chart is showing you. The price has been making lower lows, but the rate of decline on the daily RSI is slowing. That's a momentum divergence in the making, and it usually resolves with a bounce to at least the 10-day moving average near 0.7080 before the next leg down. Move to the 4-hour chart. The 4-hour is a strong sell, but the last 2 candles have formed a small doji at the 0.7025 area, right above our first support at 0.6996. The MACD on the 4-hour is still negative, but the histogram bars are shrinking, which means bearish momentum is decelerating. The 20-period moving average on the 4-hour is 0.7055, and that is the first real test for any recovery. If price can reclaim 0.7055 and turn it into support, you will see a wave of short covering that pushes it straight into 0.7101, the R2 level and a prior value area high. The 60-minute chart is neutral, stuck in a 10-pip range between 0.7020 and 0.7030. That compression is a coiled spring. When a 60-minute chart goes neutral inside a strong daily trend, it often serves as a continuation pattern, but in front of a major support, it can become a reversal launchpad. We need to see which side triggers first. Now let's connect the cross-asset linkages. The Australian dollar is a China proxy and a risk barometer. Right now, iron ore futures on the Dalian exchange are stabilizing after a 5% drawdown, and the Shanghai Composite printed a doji yesterday. That's not a bullish reversal, but it's a pause in the risk-off cascade. Meanwhile, gold, the fear architect, is holding bids above the 2,350 level despite the US dollar index edging slightly lower. The dollar is not ripping higher. It's softening on the back of a shaky Middle East truce. What does that tell you? The pressure on Australian dollar to US dollar is not coming from a dollar strength regime. It's coming from Aussie-specific weakness tied to risk appetite and the RBA's dovish tilt. When the dollar weakens but the Aussie falls faster, it's a sentiment-driven liquidation, not a macro divergence story. That kind of move tends to reverse mean more sharply than a carry trade unwind. The fundamental driver for the next 48 hours is US inflation data in view and a fresh NAB business survey out of Australia tomorrow. Yesterday's news flow was thin, but the market is pricing in a high probability that core CPI will come in sticky above 3%. If that happens, the dollar will spike and Australian dollar to US dollar will likely test 0.6967, but if the print is in line or soft, the overextended short positioning gets brutally squeezed. The NAB survey is the wildcard. Last month's survey showed deteriorating business conditions, and if we get another weak print, it could embolden the doves at the RBA and add structural selling pressure on the Aussie. But if the survey surprises to the upside, especially on employment intentions and capacity utilization, it will clash with the current strong sell signal and create a messy retracement that punishes late shorts to here's my 1 to 2 week directional lean. We stay bearish while below 0.7121, the 50-day moving average. That is the ceiling. As long as we trade below that, every rally is a selling opportunity. But in the immediate term, I expect a bounce from a 0.6996 support zone that could run to 0.7063 or 0.7080 before sellers reload. If 0.6967 breaks and holds on a daily close, then we accelerate to 0.6929 and then 0.6886, and that's where the long-term buyers will step in with size. That's the path. Do you think the dollar breaks 105 on the DXY this week? Comment yes or no. I'm tracking consensus across all 8 assets. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to give you 3 trade setups, each with an on-screen plan you can screenshot and take directly to your platform. Strategy 1 is the sniper, conservative. Wait for a dead cat bounce to sell into resistance. The exact trigger condition. Australian dollar to US dollar must rally to 0.7063 on a 1-hour closing basis. That's the R1 level and also near the 5-day moving average. We need to see a clear rejection wick or a bearish engulfing 1-hour candle closing back below 0.7055. Entry on the breakdown below 0.7055 with confirmation. Stop loss goes at 0.7085. Just above the R2 level and the 10-day MA, giving the trade enough room to breathe past noise but protecting against a structural breakout. Take profit. 1 is 0.7000, a psychological level just above the 0.6996 support. Take profit 2 is 0.6967, the invalidation level for the short-term bearish structure. The risk-reward ratio on this setup is 1 to 1.9 on the first target, and 1 to 3.2 on the second. Invalidation. Void this setup entirely if the daily candle closes above 0.7101. That would signal that the bearish structure is breaking and the daily strong sell is no longer dominant. The sniper, conservative, entry, 0.7055, 1H close below after rejection at 0.7063, stop loss, 0.7085 take profit 1. 0.7000 take profit 2, 0.6967 risk, reward. 1:1.9 R to 1:3.2 R invalidation. Void if daily candle closes above 0.7101. Strategy 2 is the active trader, a standard mean reversion play exploiting the compression and the likely short squeeze. Entry condition. Australian dollar to US dollar tests 0.6996 and holds without a 4-hour close below. Wait for the first 4-hour candle to close back above 0.7015, confirming a rejection. Enter long on the open of the next candle. Stop loss is placed tightly at 0.6985, 10 pips below the S1 and just beneath the intraday liquidity that will have been tested. Target 1 is 0.7063, the R1 level where the sniper short would trigger. Target 2 is 0.7080, near the 10-day moving average and a prior consolidation zone. The trailing stop rule. Once target 1 is hit, move the stop loss to break-even and trail by 20 pips on any further extension. This setup has a risk-reward of 1 to 3 on the first target alone, and it capitalizes on the panic exhaustion I showed you in the CCI and ADX readings. Invalidation. Any 4-hour close below 0.6967 instantly voids this trade and flips the aggressive bias back to full bear. The active trader, standard, entry, 0.7015, after 4 hours close above and rejection at 0.6996, stop loss, 0.6985 take profit 1, 0.7063 take profit 2, 0.7080 risk, reward, 1:3.0 R invalidation, 4H close below 0.6967. Type your Australian dollar to US dollar range for tomorrow in the comments now. Let's see who's aligned with the 0.6996 to 0.7080 range. Strategy 3 is the aggressor, high risk, countertrend, not for the faint-hearted. This is for traders who understand that the fastest moves come from failed breakdowns. The setup: if price spikes below 0.6996, hits 0.6980, and then violently rejects on a 5-minute candle closing back above 0.6996, that is a classic stop run and a fake breakdown. Entry on the 5-minute close above 0.6996. Anticipating a liquidity grab. Stop loss is extremely tight at 0.6960, below the S2 level and below the lows of the fake-out spike. Target 1 is 0.7034, the pivot point. Target 2 is 0.7063. This is a momentum chase with an expected risk-reward of 1 to 2.8 if target 2 is achieved. Explicit warning. This trade must be executed with a position size that risks no more than 1% of your account, and you must accept that the failure rate on these setups is higher. Only for those who can lose small and manage risk aggressively. The aggressor, high risk, entry, 0.6996, 5M close above after fakeout to 0.6980, stop loss, 0.6960 take profit 1, 0.7034 take profit 2, 0.7063 risk, reward, 1:2.8 R invalidation, 5M candle closes below 0.6975 after entry. Never risk more than 1 to 2% per trade. No positions through high-impact news, and stops are non-negotiable. This is how you survive to trade the next big move. As we close out, let's lock in the single most critical level. 0.6967 is everything for the next session. If that number breaks and holds, the Aussie could be in a swift move to 0.6886, erasing months of gains. But if buyers defend it and the US CPI data gives them a catalyst, we could see a violent rip to 0.7100 that crushes late shorts. Tomorrow, I'll be focusing on the S&P 500 gamma levels and how they interplay with the dollar's direction after that CPI print. An explosive cross-asset divergence is brewing and it connects directly to this Aussie setup. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.